You're watching the Real Tea with ESG, and I'm your host, Evan Saint-Gerard. Today's guest, special guest, all the way from the warm state of Florida. I'm kind of jealous because I'm still shoveling in my driveway right now, is Stephen Rosen, CPA, the man, the myth, the legend. Steve, we're talking today about, today's subject is tax ramifications when you're selling a personal residence. So I'm gonna give, the floor is yours. Go ahead, speak to the audience.
Okay, so every year I'm like astounded that clients will come to me and say, oh, I sold my house, but I bought a new one that costs more money. Don't I get to defer the gain? And that rule went out about 30 years ago. And so it's important to discuss what are the rules now for selling a personal residence. And for those of you who are actively involved in real estate, this might be something you know. But the reason I want to talk about it is because there's enough people out there, including realtors, not this one, because this one knows everything.
I hired the right people, so I know everything.
Who are just unaware what the rule is. And the rule is this: if you're single, you could, and you sell your residence, you could defer up to $250,000 of gain. If you're married filing jointly, you could defer up to $500,000 of gain. The rules to allow that are you have to have lived in the house for 2 of the last 5 years. It has to be your principal residence. There are some exclusions to that, exceptions, I should say. If your job changes and you have to move, then you could do an allocation of number of months in the house divided by 24 times the gain. And that's one exception. And the other exception, it could be for medical. If you're physically unable to live in the house because of a medical condition, then you can do a similar type allocation. And another exception would be if you're in the armed services and you're sent overseas. So there's different rules about that. A lot of rules about people who are serving in the armed forces. But again, the basic rule is $250,000 exclusion if you're single, $500,000 exclusion if you're married filing joint. So if you bought your house for 300 grand and you're married, and you go to sell it for, say, 750, you have a $450,000 gain. Of course, you subtract the cost. That is the 300,000 is your cost basis. The 750 are your proceeds. That difference is only 450,000. So you get to exclude the gain. If you get a Form 1099-S, which shows the $750,000, then it has to go on your tax return, but it's not taxable. It's just matching up an IRS document so IRS could see that you actually reported it, and that's very important. If you don't get a 1099-S, then IRS is probably not going to know about it. If you sold your house for 1.5 mil, and it cost you $300,000, then you are going to have a capital gain minus the 500 grand. So, that's a very nice break that they give you. That's if you marry filing joint, $250,000 exclusion if you're single. And there's other rules involved, like if you get divorced, it's sort of favorable. Like if one person has to move out, as long as your ex is still living there, then the amount of time that she's there accrues to your time.
Or he.
Yes, or he, excuse me.
Now, question, what if it's, since it's let's say it's over $1 million, isn't there a mansion tax as well?
Yeah, for New York State, there's a mansion tax, which is separate from the exclusion.
All right. Is there anything else that you want to let the audience know?
With regard to the sale of a personal residence, there's always extra stuff. If you ever rented out part, then you might lose part of that exclusion, but that could be a whole 8-hour discussion. But it's there. So there's always something more than what I'm going to say, but these are the basics, which I have to explain to people on a regular basis because they're just unaware of it.
All right, so I guess the best thing for people to do, if they have questions, they should reach out to a CPA, a licensed CPA here in New York, possibly in Florida, in New Jersey.
Well, I'm licensed in New York and in Florida.
I just happen to know one who's speaking right now. So if you need advice, guidance, you call your CPA or you call this person right here who's speaking right now. His name is Stephen Rosen. Stephen, tell them your phone number and how they can reach you if they need advice.
Okay, so my cell phone is 516-491-3887. My office is 561-609-2388. And if you happen to be in New Jersey, you could call 908-403-4419. And I just want to add that I moved out of Long Island in 2015 and set up shop down here, and I haven't seen snow since.
Lucky you. He kept his Long Island number. I'm going to send some snow over your way, man.
Okay.
Anyway, Stephen, thank you so much. This has been the Real Tea with ESG. You have any questions, always feel free to ask. That's what these videos are for. Feel free to share this with a friend, family member, a cousin, your ex, whoever. There's going to be important information that always comes out that you're going to need. That's what we're here for. So talk to you soon. Enjoy your tea.